Hi, my name is Chris McCauley. I'm with Strategic Planning Group, and this is our first ever quarterly video where we will be sharing financials from 2020. This is the first of what we intend to be a quarterly update on the stock and bond markets. This update will focus on the markets and will be a little number heavy for some. Additionally, we will be starting a monthly video featuring financial topics. Our first will be on fiduciary. For our 2020 recap of the stock and bond markets, the Standard & Poor's 500, an index of 500 large U.S. companies, it increased by 18% for the full year, January 1st through 2020. The S&P 500 growth, a subsector of the S&P 500 focusing on growth companies, was up 33%. A different subsector of the S&P 500, the S&P 500 value, was up only 4%. The MSCI EFA, a measure of international stocks, was up 12% for 2020. The MSCI Emerging Markets Index was up 24% for 2020. And finally, the U.S. Aggregate Bond Index was up 7.5%, which is a big number for the bonds. Earlier in the year, in the first quarter of 2020, the S&P 500 had declined 34% when the country, a good chunk of it, shut down because of the pandemic. Over the remainder of 2020, the stock market and bond markets did recover. It was a very volatile year. In 2020, we had 44 trading days where the index was up or down more than 2% in a single day, the most since the financial crisis back in 2008 and 2009. With the U.S. Federal Reserve intervening in a very big way, then the CARES Act being passed by Congress and signed by the President in a very short period of time, the credit markets, the stock market, recovered over the rest of 2020. U.S. large technology stocks led the way by a wide margin over areas such as banking and oil stocks. As we are believers in asset allocation, or putting your eggs in several investment baskets, our client portfolios benefited from so many parts of the investment markets increasing in 2020. Enough of the numbers. What does it mean for you? For 2020, almost all the categories were positive. Thank you for hanging in there during the wild, many times stressful ride that we had in 2020. For 2021, we expect an economic recovery in the U.S. due to the vaccines and their distribution throughout the year. With the vaccines, we think there will be an economic recovery where non-technology parts of the stock market should benefit. We have already seen this in the banking and oil sectors as they have gotten off to good starts in 2021. We expect interest rates, especially in savings accounts and money markets, to remain low due to Federal Reserve policy. These accounts are great for protecting your assets, but could have what we call negative real returns, or returns less than the rate of inflation. This silent negative return erodes your ability to pay for your cost of living. Cash for emergency funds is a great idea. Be careful how much you have in these kinds of accounts. Although bond markets were strong last year, this was primarily due to the Fed lowering rates and other actions. While the Fed will continue with these policies, the big drop in rates in 2020 is unlikely to be repeated in 2021. When interest rates drop, bond prices rise, and that can drive higher returns for bond investors. We don't see 2020 repeating in 2021 in the bond markets. Thank you so much for turning into our first quarterly video. We will be putting together monthly videos and sharing more financial information and knowledge with you. We hope you watch those as well.